Hi, I'm Tom Dalton. If you are wondering how to allocate non-recourse liabilities to partners at the end of the year, this is the right video. There is another video that describes how to allocate recourse liabilities. In this video, I'll show you how the Treasury regulations require non-recourse liabilities to be allocated so that a partner can correctly calculate his or her tax basis in the partnership interest.
There are some things you need to know before you can allocate non-recourse liabilities. I'll list them here, and if you are not familiar with them, you can watch 3 other videos I have that will bring you up to speed. First, you need to know why we even care about liability allocation and how it affects a partner's tax basis in the partnership. You also need to know the difference between recourse and non-recourse liabilities. You can get a good review of these two concepts in my video, Recourse Liability Allocation. You can find this video and other videos organized at taxbootcamp.com under the Partnerships tab on the video page. Here's how you find them. Second, you need to know about substantial economic effect and especially how to calculate 704B minimum gain. You can get a good review of this concept in my video, Substantial Economic Effect, Part 2. Again, you can find the link to this video at taxbootcamp.com. Third, you need to know about 704C minimum gain. You can get a good review of this concept in my video, 704C, Part 1. Like the others, you can find the link at taxbootcamp.com. If you already understand these 3 concepts, then let's go on and use this example to illustrate how the Treasury regulations direct us to allocate non-recourse debt. Notice that this is a limited partnership with 2 general partners and 1 limited partner. Also notice that the tax basis balance sheet is the same as the 704B fair market value balance sheet. The 704B balance sheet hasn't been revalued to current fair market value because no revaluation event specified in the Treasury regulations has yet occurred. Jimmy and Joan are general partners, and Juanita is a limited partner. Jimmy and Joan both have a 40% interest in profits, and Juanita has a 20% interest in profits. Jimmy and Joan both have a 25% interest in losses, and Juanita has a 50% interest in losses. Assume that Juanita has not agreed to a negative 704B capital account restoration requirement. But that's okay so far because there haven't been any revenues and the only expense is depreciation on the building. The $45,000 of depreciation expense on the building has created a $45,000 loss, which was allocated to the partners according to their loss ratios. That's why all 3 partners have negative capital accounts, both tax and 704B. Negative 704B capital accounts for the general partners are okay under the substantial economic effect rules because both general partners have agreed to an unlimited deficit capital account restoration requirement in the partnership agreement. The negative 704B capital account for the limited partner is also okay under the substantial economic effect rules because it is the result of non-recourse deductions, specifically the depreciation expense. Juanita's 704B capital account can go negative to the extent she is allocated 704B minimum gain. 704B minimum gain was created when the 704B basis of the building fell below the amount of the non-recourse debt on the building because of depreciation expense. 704B minimum gain is calculated separately for each property. The non-recourse mortgage is $140,000. The 704B basis of the building is $95,000 after depreciation. The 704B minimum gain is therefore $45,000. The partnership agreement allocates this minimum gain by the same percentages that it allocated the depreciation expense to the partners. The 704B minimum gain lurks in the background. It is triggered only if the partnership defaults on the non-recourse mortgage. Maybe you notice that the land also has a non-recourse mortgage that is greater than the 704B basis in the land. The reason this minimum gain is not included in the 704B minimum gain is because this gain was not created with non-recourse deductions. There is no depreciation expense on the land, and no deductions, or distributions of debt, have occurred. Allocating non-recourse liabilities to partners is done in 3 steps. First, allocate non-recourse liabilities to each partner based on the partner's share of 704B minimum gain. As you can see, $45,000 of non-recourse debt is allocated within this layer, $11,250 each to the general partners and $22,500 to the limited partner. The second step is to allocate non-recourse liabilities based on the partner's share of 704C minimum gain. The 704C minimum gain is calculated the same way as 704B minimum gain, except that the 704C minimum gain is the non-recourse debt in excess of the property's tax basis, rather than the 704B fair market value basis. In our example, the 704B basis and the tax basis are the same number, $40,000, but they could be different. This is where the non-recourse mortgage on the land comes into play. We discovered that the land and the cash was contributed to the partnership by Juanita. At the time of the contribution, the land's tax basis was $40,000. The mortgage on the land was $50,000, so the 704C minimum gain on the land is $10,000. It's important to distinguish 704C minimum gain from total 704C gain when contributing property to a partnership. If the fair market value of the land was $65,000 at the time of the contribution, then there would be another $15,000 of total 704C gain. But this additional $15,000 of 704C gain is not minimum gain and would not be a part of the second step in allocating non-recourse liabilities. The 704C minimum gain is allocated to Juanita because she's the partner who contributed the land to the partnership. So, $10,000 of non-recourse debt is allocated to Juanita in the second step. In the third step, we allocate the remaining non-recourse liabilities by however the partnership would normally allocate profits to the partners. If there was, in fact, additional 704C gain that was not 704C minimum gain, it would affect the allocation of non-recourse debt in this step. But in our example, the only thing left to do is to allocate the remaining debt by the profit-sharing ratios, 40%, 40%, 20%. The 2 general partners are each allocated $54,000 of the remaining non-recourse debt, 40% of $135,000. Juanita is allocated $27,000 of the remaining debt, 20% of the $135,000. When we add all of these 3 pieces, Jimmy and Joan are both allocated $65,250 of non-recourse debt. Juanita is allocated $59,500 of non-recourse debt. There are a couple of things to note. First, when allocating partnership liabilities, the non-recourse liabilities are allocated to the partners before the constructive liquidation scenario is used to allocate recourse liabilities. Second, what would happen if this were an LLC and all of the members have limited liability, and there are what we would normally consider to be recourse liabilities? If no one has personally guaranteed the resource liabilities, and this is an LLC, then the recourse liabilities are considered to be non-recourse and would be allocated under the 3-step process we just described.
Thanks for watching. If you have any questions or comments, feel free to send me an email. If you like this video and would like to see more, feel free to subscribe.